welcome everybody online. I'm Natasha Isalovich. I'm the city lead here at Foundation Center West. I'm really happy to introduce Jean Takagi and Michele Berger from NEO Law Group to you today. They're going to be discussing the top 10 tips to get you ready for 2017. Top 10 legal tips to get you ready for 2017. Hopefully you're already receiving our e-newsletters and you know about the next live stream that's happening same bat time, same bat channel next week with Andrea Lloyd from Just Give. So I'm going to turn everything over to Jean and Michele, and I hope you enjoy it.
Hi, everyone. Thank you to the Foundation Center for having us, and let's get started. Thank you all for joining us as well. So the first question you'll want to ask is, have you filed all the necessary documents with the applicable tax authorities? So for the IRS, this is Form 990, and you'll want to make sure you're filing the correct 990 for your organization, and potentially the 990T if you generated any unrelated business taxable income. You also may have a tax-related filing, a state tax-related filing, as well as an employment tax-related filing.
This is a great area for you to develop a checklist because there's so many possible filings that you might have to consider. So in addition to some of the filings that Michele had mentioned, don't forget the W-2s and 1099s that will be due out January 31st for your employees and independent contractors. Think about the local business registrations. Just because you're a nonprofit doesn't necessarily mean that you're exempt from local business registrations, including in San Francisco here in our local city. Licenses and permits, you might need to consider those and whether you need renewals. Property tax exemption, another area where you may have an annual filing that's due, and lobbying registration for those of you who engage in some lobbying, and we'll get back to that later, but lots of things. Best way to do it, it's holiday time. We always come up with checklists around holiday time. So come up with a checklist of your annual filings, get it on the list, and you can refer to it every year.
Another thing you'll want to look at is whether you're registered and qualified to do business in your state. So in California, that is a filing with the Attorney General, and the first filing is Form CT1, and then the subsequent annual filings are the RRF1, Form RRF1, which you will, again, file annually with the Attorney General and attach your 990 for that year as well. And if you're not in California, you'll want to make sure you're qualified and registered with the body that oversees charities in your state. There also may be a Secretary of State filing, which is generally a list of officers and directors and an update to the agent for service of process. In California, that's the Statement of Information, which can be filed online and is required every 2 years.
On the charity regulation filing that Michele was talking about, it's somewhere between 36 and 39 states in DC that require it. So check it out to see if you're required to register as a charity. It's not only in the state in which you may think you're operating or in which you've been formed. It may also be in the state in which you're fundraising, and that becomes a little bit difficult and confusing to think about when we have online fundraising now. And so there have been some principles adopted by a bunch of state regulators. They created their own association, and they've come up with something called the Charleston Principles. And I think this is almost 20 years ago now that they first came up with it, so we're kind of behind the times still. But basically they said, well, if you're soliciting in a particular state outside of your home state, and it's on a repeated and ongoing basis, they didn't really define what that meant, but they gave us an example of 50 solicitations there, or receiving 50 small gifts, which might happen through an online Donate Now button or a crowdfunding site that you're sponsoring. So repeated and ongoing or substantial basis, which as an example, again, they said 25,000. But there are only 2 states that have actually adopted these principles. Everybody else is just using them as rough guidelines in order to figure out whether they should comply or not. But if you've got 25 to 50 solicitations, you're raising more than $25,000 from not other than institutional foundations and big corporations, you may want to think about registration and getting into compliance with all of the local state registrations. Reporting and registrations. Also think about whether you're using professional or commercial fundraisers, because they need to be registered as well in particular states, and you've got to check that out. So before you enter into a contract with them, make sure that they're registered if that's required in that state as well.
It's also really popular at the end of the year to give bonuses to your employees. But one thing you may want to think about when giving a bonus to an executive is whether it needs to be approved by the board. And the approval that may be necessary is of the total compensation for that executive, not just the bonus, because the total compensation has to be fair and reasonable. And the board is charged with determining whether that compensation is fair and reasonable. Excess benefit transactions can apply if the IRS finds the compensation to be excessive, which could result in penalties against the disqualified person who received that excess benefit, as well as the foundation managers who approved it.
Now, on the bonus issue, states sometimes think you're misusing charitable assets if you're paying for something that you've already paid for. So it kind of makes sense if you paid $5,000 for a used car and you kick in an extra $2,000 because you like that particular seller. Then obviously that's a misuse of charitable assets. But that can also apply in some states' thinking when you give a bonus to an employee who's already been paid and already negotiated a salary. So it gets a little confusing, and it sometimes doesn't seem very fair to charities that would apply, but that's something that you have to think about. One way to sort of factor that into your consideration is to put the possibility of a bonus in the job offer letter, or if this person has already been hired for that position already, in the job description, so that there's this understanding that they're not overpaying when they're giving a bonus and taking into account total compensation, but they are triggering the possibility of a bonus based on certain factors that they agreed upon in advance. So get those bonus provisions into the job descriptions at the beginning of the year if you don't already have them, and incorporate them in your job offer letter if you want to offer the possibility of bonuses and want to stay away from that state issue about whether they're misusing monies or not. Also, when you think about bonuses, make sure that they're not tied explicitly just to revenues, because you create this perverse incentive for somebody to say, hey, if we hit our revenue goal, then I'm going to get my bonus. But maybe hitting that revenue goal will be at the expense of making certain expenditures in furtherance of your mission. So you don't want to tie performance just to hitting revenue targets. You want to tie it also to performance and mission.
And while we're talking about executive compensation, it's a good idea to review and approve the executive compensation anytime a new executive is hired or when the compensation changes. So an across-the-board increase for cost of living might not warrant the board review, but any substantial change or a new executive the board should look at.
And Michelle had earlier talked about when you approve a bonus, you should approve the total compensation. And of course, when you hire somebody, you've got to approve their total compensation as well. If they're an executive, in some cases, the CFO applies in that situation as well. So board level or board authorized board committee approval of the executives and possibly the CFO's total compensation. If you think you're going to be paying anywhere close to market value, or possibly it might even be a little bit more aggressive and maybe more than market value, you've got to be very careful, because if you overpay, you could be subject to penalties, excess benefit transaction penalties that Michelle referred to earlier. So in that case, the regulations give you this opportunity to get a rebuttable presumption of reasonableness. Lawyers know this term and like using it, and nobody else really understands it. So just in very quick basics, what it means is getting the approval of a majority of the board of disinterested directors, those directors who don't have a conflict of interest in that compensation arrangement, making sure you're using appropriate comparability data. So that's taking a look at similarly situated, a little bit of a alliteration and tongue twister there, similarly situated, really tough for a Japanese dude too. So similarly situated organization for similar position. And if you find that the total compensation is within that range, then again, you meet that that part of the requirement. The third part of the requirement means that you need to timely document it. So that's getting it into the board minutes, getting the board minutes approved, or unanimous written consent or other written consent, whatever the state laws require for board approval of that. So you'll want to make sure that you get that done to get that rebuttable presumption of reasonableness. Also wanted to quickly mention that compensation might be tied to performance reviews, as I had mentioned before with bonuses. So if you're going to do a performance review and you're going to adjust somebody's compensation, you want to make sure that you're targeting that and calendaring that in the right way. Also, there has been talks from time to time about changing overtime rules, and from year to year, depending upon when you're watching this particular live stream. But for those of you who are watching live this year, there's been a pause on some proposed regulations on overtime rules that were supposed to be in effect December 1st, and that's been paused. It's something to keep an eye on because that's going to be a federal rule, and so that would affect all employees of nonprofits that might be subject to those provisions. Lots of minimum wage changes happening each year as well, typically effective January 1st, so keep your eyes on that in whichever state you're in.
Great. Another thing to look at is whether the purpose statement listed in the organization's articles of incorporation and bylaws are consistent with each other, and then also with the organization's actual mission and activities. So under the charitable trust doctrine, if the purposes listed in the organization's articles and bylaws is limited to certain activities or locations, the use of the funds it receives will also be limited to those activities and locations, even if circumstances change in the future. So it's a really good idea to take a look at these documents. It's one of the first things we do when we get a new client is we'll look at the purpose statement in the articles and bylaws and ensure that they're consistent and consistent with the activities that the organization is actually engaged in. So if they're not, it's a good idea to amend or restate your articles and your bylaws.
Yeah, and so a really good way to understand this is maybe people have a better understanding of charitable trust principles when we talk about restricted gifts. So if somebody gives you a restricted gift and says, you must use this to support the opera in San Francisco, and you accept that gift, well, then you're accepting it based on that condition. So you've got to use it for the opera in San Francisco. Now, if your articles or bylaws state that your purpose is just to support the opera in San Francisco, you can't suddenly start to raise money to support animal shelters and grassroots organizations in sub-Saharan Africa. And that's outside of your stated purpose in your articles and bylaws. And sometimes organizations evolve over time, and you can shift missions, maybe not as dramatically as I had mentioned, but you can shift missions from time to time. And Michelle mentioned geographic limitations, a common thing that we find in articles and bylaws that changes over time as people start to expand, look at different funding sources. And they change their mission statements, which are on their on their websites and on their grant applications and stuff, but they don't go back and get off the shelf their articles and bylaws, which may have been sitting there for many years without anybody looking at it. So we say, as a part of a regular practice, and maybe annually, just take a look at your articles and bylaws, look at that purpose statement, and then say, are we in compliance with it?
And while we're talking about bylaws, whether it's every year, every 2 years, every 3 years, whenever the bylaws state a term of an officer or director, you want to make sure you're holding elections at the end of the term. So that could mean electing new directors or re-electing the same directors and officers, but make sure you're holding those elections. And if your bylaws are silent as to the term length, the particular state law may provide a default.
And Michelle and I see this quite a bit, and that's when people start to call lawyers. So you've got a procedural defect because you haven't complied to the letter of the law of how you nominate your directors or how you elect your directors, or people forget to elect their directors because the board doesn't change from year to year. And all of a sudden, you've got somebody who disagrees with what the board is doing, and they say, we want to stop it. And they might even threaten to litigate on it, bring you to court and say, this action isn't valid. And how far back can they go? If you don't have a properly composed board, you really can get into a lot of trouble. And
expensive legal fees, too.
Yeah, really good point. And maybe in kind of the worst case scenarios, which we've seen actually multiple times, you end up with two groups of people who both say that they're the board of directors of the organization. And they get into an extensive fight about who controls the bank account. The bank freezes the bank accounts. They go to court and they sue each other. They say bad things about each other. They end up with defamatory statements about each other, and they get personal lawsuits, and it gets ugly real fast. Yeah. So worst case scenarios. But be careful. I mean, take a look at whether your election procedures are being followed. If they aren't, talk with somebody and get back into compliance, change it up. if you need to. If you need to simplify it, change it up, make sure it's consistent with the law. But you really need to be looking at that, because anytime there's a source of trouble, any action that you're going to take as a board that might be a little bit in dispute, that can be a trigger for all sorts of nasty things to happen.
So scattered throughout the Form 990 are questions related to whether the organization has adopted various governance policies. And an organization can only check yes if the board adopted the policy within the reporting year. So examples of these policies include a conflict of interest policy, which may not be required in your state, but is increasingly becoming a best practice, and we recommend it for every organization. An executive compensation approval process, a review process of Form 990 by the board, gift acceptance policy, expense reimbursement policy. The general idea here is that if you don't have these policies or a majority of these policies, increasingly you're becoming an outlier. And if you become too far of an outlier, that may raise a red flag for the IRS for an audit or an examination. And aside from the possibility of raising a red flag, these policies create good governance practices, and so they really should be considered by the board and discussed at least at a meeting.
Yeah, so the 990 refers to many of these policies that Michelle's been talking about, and it's true, it's really good practice to have these in place apart from possibly triggering an audit. But do note that the IRS has recently, very recently, just this year, started making the 990s available in machine-readable format, and that allows them to use this big data to accumulate and find those outliers much, much easier than ever before. So you can quickly find yourself being so much of an outlier that you're on the target of an examination or IRS audit, which is no fun at all. Don't recommend that if you can avoid it. So it really is important to make sure that you think about adopting those policies for multiple reasons. Also consider that with this machine-readable format, potential adversaries of the organization or of the organization's messages or mission may also be able to easily find out whether you're engaging in good governance practices or whether you're just it looks like you're not engaging in good governance practices because you don't have things like a conflict of interest policy, which again, I'll echo Michelle saying everybody should have one of those. So really think about doing that, because we've got charities ratings agencies, we've got organizations who might be on the other side of a particular issue that you really advocate. We've got media who are looking for juicy stories about nonprofits that are doing things wrong. So make sure you really consider those policies very carefully.
So those policies are listed on Form 990, but not on the Form 990 PF, which is for use by private foundations. But that doesn't mean that private foundations shouldn't also consider adopting and adopt those governance policies. So private foundations are subject to a host of additional rules that public charities are not, including our next tip about minimum distribution requirements. So a private foundation must spend a minimum of 5% of its investment assets for grants, administration, or other charitable distributions annually. So again, this doesn't apply to public charities, but if you are a private foundation, you want to make sure that you're working with an accountant before year end to make that qualifying distribution.
And figuring out what a qualifying distribution is really important. So grants, of course, are going to be part of those qualifying distributions, but you may have some internal expenses or payments for assets that you're going to be putting to use for charitable or other tax-exempt 501c3 purposes, as Michelle had mentioned earlier, and that may be included amongst your qualifying distribution. So that might include things like paying for preparation of your 990 PF form. It might be putting on a conference or creating, publishing, and disseminating a publication. Those are all things that might be covered as a qualifying distribution and part of that 5%. So that'll give you a little bit of an idea of how you might meet your minimum distribution requirements as a private foundation. Do talk with your accountant, though, to make sure you've got that absolutely right. One other type of qualifying distribution that I think is often overlooked, and the vast majority of private foundations don't use this type of qualifying distribution. It's called a program-related investment, or PRI, and I think it's got the potential for fantastic usages. We've been talking a lot in the sector about impact investments, and program-related investments are one form of impact investment where a foundation is making an investment. It could be a loan, or it could be even a purchase of equity in a for-profit social enterprise, but it's making it in furtherance of its exempt purpose, and not primarily or not significantly to produce income or to have an appreciation of capital. So it really is a form of mission-related investment, although some people call those things different things. So the PRI is a way to possibly make a loan or equity investment and get that money back at some point and reuse it again. And it still counts as a qualifying distribution if you do it right. I'm tremendously excited about PRIs, and I think that we're going to see more and more use of that in the coming years.
So it's also a really good idea at year end to review the financials and budgeting for next year. So a good place to start is to look at how the year to date is progressing in relation to the budget, and pay attention to whether the projections and revenues were accurate, and whether the organization is performing favorably in relation to the budget. So if not, sometimes you may need to consider adjusting your variable costs. And if you aren't balancing your budget each year and you don't have a reserve to fall back on, you may be going insolvent. And the board has a fiduciary duty to act within the best interests of the organization, which includes making those difficult decisions when necessary to make sure that the organization is more financially stable. So developing a budget for next year is really important, and it's best to do it as soon as possible so that the executive has a plan to work with.
Yeah, there's so much to learn from financial statements. But it takes being able to read, interpret, and use that financial information to really engage in prudent financial management. And that's on both the management level, the executive level, the officer level, the finance committee level, and the board level. So making sure you've trained and set aside adequate resources to train all of your key individuals who need to know how to read financial statements and use them properly. Doing it, that's a great investment that every organization should consider. And you want to make sure that you're aware of if you're going insolvent, as Michele had mentioned, or if you're appropriately allocating your resources to advance your mission in a prudent, effective, and efficient way. Those are things that you're all going to consider, and you'll want to know how to read your financial statements to try to figure some of that out. Financial statements with nonprofits are particularly difficult to read because the 1 year reporting period is not necessarily the easiest way to understand the financial health of an organization. We've got all sorts of timing issues in the nonprofit sector because funding for some of our programs may not coincide with our expenditures. Sometimes you get them 1 year and not in another. So as we get
questions
from out of the ether, just making sure that you understand that there are timing issues, and boards may want to take a look at not only the reporting period at issue, but may want to take a look at multi-years to see what the performance is really like and the financial health of the organization is really like. Also, Michele had mentioned about holding an executive accountable for performance according to the budget. You'll have to think about whether that's going to be fair. And if you give a budget to an executive 6 months into the year, maybe that's not so fair. If you give them to them in the beginning of the year, maybe that's fair. But the budget is also kind of a little bit of a living document that if circumstances change, you want to be able to react to that and amend the budget and still hold the executive accountable for certain performance measures against the budget. So how you exactly do that is tricky. Whether you need an audit or not is also really important to consider. Sometimes the law requires that you have an audit, sometimes not. So think about those things.
So I'm going to get to our last point so that we have time for your questions. We highly recommend creating a board calendar for the upcoming year. So let's say that you have 6 meetings ahead of you, allocating various topics to those meetings to make sure that the board considers and reviews them next year. And one thing you may want to put on your board calendar is a program review. So it's often forgotten, but it's a good idea to review and discuss how the organization's major programs are performing, and that may inform your plan for next year as well. If the ultimate goal is the mission, you want to make sure that you're placing proper emphasis on the programs in addition to the financials. And then a legal compliance review might be another topic that you put on your board calendar. By watching this program, you're already living up to part of your responsibilities of putting together a legal audit, but the board will want to take a look at the risks and see how the organization is mitigating those risks and protecting their charitable assets.
And I'll echo the program review and how important that is, because nonprofits exist to advance their mission, not to produce a bottom line, although the bottom line is obviously important in your ability to advance your mission, but really reviewing the impact of your program is important and difficult to do. Also, review your values and how you make your decisions. Your values should guide every decision you make as a board and as an executive, so you want to make sure that you're reviewing those. And consider what strategies you need to implement to advance your mission best. So advocacy is oftentimes something that organizations are underutilizing as well. And quick tip, 501h election for lobbying. Lobbying also vastly underused. Public charities can lobby to a pretty generous amount. If you elect 501h, it's really simple. So we'll give you some more details, but let me go through some of the questions that you've asked. Are there legal tools that you can recommend that are low cost?
There are a number of resources online. We have a blog, actually. This is a great place to plug our blog, the nonprofitlawblog.com. We have a ton of resources, articles about a lot of these topics, including a sample board calendar. We'll have that all up on our blog later today. So check that out. That's a great free tool to use.
And I'll also mention that the IRS has a great site as well for nonprofit organizations.
So what training would you recommend to learn and read financial statements?
Oh, really good question.
Great question.
So it depends upon the state that you're in, but there are some organizations that give you some tips. So the Foundation Center has a wealth of resources, of course. The National Council of Nonprofits also has some resources. The Nonprofit Finance Fund has some resources. And we'll put up some more on the web. So again, financials aren't usually the strength of lawyers, but we'll put up some tips to get you in touch with some of the folks who can give you more help on that.
So we have another question that is similar to the last two. Are there resources you can refer to help nonprofits stay up to date when it comes to the law and compliance?
So great question. So we mentioned our blog, the Nonprofit Law Blog. The IRS website for exempt organizations. So it's called technically the Tax Exempt and Governmental Entities Division of the IRS. They've been going under a little bit of scrutiny over the last few years, and some changes at the IRS, including some hits on their budget, but they've got one of the best websites full of governmental resources on how to comply with 501c3. Your states may also have great resources for charities and state law compliance. So check.
Yeah, in California, the Attorney General's website, the Registry of Charitable Trusts, they have a lot of tools, and including a PDF full of information about how to comply with state requirements.
Yeah, Guide for Charities, which one of our colleagues helped to
Aaron Broderick
modify. So great resources from state charity officials, Foundation Center again, Nonprofit Council, National Council of Nonprofits, and various others. So again, check our website out for some of those additional resources as well. There are a wealth of tools out there, but you can also quickly get buried by that information. So take a look to see if, as you are working on comprising your board, or looking for possibly advisory committee people, see if you can get some different people with different expertise on the board that might be able to contribute in keeping up with some of these areas of the law. Make sure you set aside a little bit of time at each board meeting, or maybe every other board meeting, to talk about current events and what might be out there that could impact the organization, and what you might do to address those particular changes or concerns.
So again, we'll have some resources listed on our blog with some of the topics that we discussed today. So feel free to check that out. Thank you very much for joining us.
Thank you very much.